Mr. Speaker, others in this House, in particular my honourable friend 𝐜𝐨𝐲 Lim, have previously articulated reasons as to why the MAS's Shared Responsibility Framework, or SRF, is inadequate and unjust. While I support the motion as it stands, I will elaborate in my speech today on why, as currently conceived, it remains fundamentally unfair, in stark contrast to its stated aim of equitable sharing. The official press release describing the framework states that, and I quote, "All parties have responsibilities to be vigilant and to take precautions against scams," end quote. Financial institutions need to implement robust controls to safeguard customer accounts and to detect and clamp down on suspicious transactions. Customers need to take precautions to not frivolously release their banking credentials and to practice cyber hygiene. Losses would then be assigned according to how far each party falls short of these responsibilities. Now, all these sounds reasonable on its face, but in practice, fraud is almost always perpetrated on the weaker link in the chain, in this case, the vulnerable consumer, more often than not, than on the relatively better equipped and technologically sophisticated bank or telco company. Hence, the equitable sharing framework becomes less about fairly distributing losses, but about distributing responsibilities. Losses, when they occur, will, it would seem, appear overwhelmingly borne by the consumer. Put another way, we should only expect the framework to yield equitable outcomes if the fair assignment of responsibilities were all that mattered. Anyone who has bargained over the price of fish or vegetables at the market, or negotiated a salary or raise with an employer, or taken part in discussions over the distribution of chores or workload, know full well how power differentials matter massively and how they alter how the pie ends up being split. This is not mere speculation. A large literature on the theory of bargaining shows that those in possession of power tend to do better in negotiations. In cases where the bargaining is explicitly antagonistic, canonical models suggest that those who are more patient and are able to make the first move possess an advantage. Even when we allow for the possibility that players see the benefits of cooperation and embed this in their negotiations, the outcome remains heavily conditioned by each party's relative bargaining power. Moreover, those who are better able to walk away tend to do better. If we look carefully at the two parties involved in negotiating a settlement over fraudulent claims, it is clear who has the greater power, patience, and ability to hold firm to their offer, and that is the bank. Financial institutions are not only larger. If they can simply demonstrate that they have not erred in effecting a fraudulent transfer, they can currently credibly insist on refusing any share of the loss altogether. And write-offs, when they do occur, are typically only a small fraction of the institution's balance sheet. In stark contrast, scams are often ruinous for the depositor. At the extreme, they could constitute either an individual's entire life savings, or worse, it could saddle an unwitting mule with onerous debt. What is the split then that best reflects distributive justice? While there are variations, many have concluded that a 50-50 split, or something close to it, is the only just solution to most bargaining situations. Importantly, the notion of a 50-50 split should not be seen as one where each party takes an equal nominal share. Rather, the notion of an equal split suggests that each is made to bear a burden that is commensurate with what they are able to afford. And this is why the government needs to step in to empower depositors with a more robust set of laws that offer financial protection to consumers. At the simplest level, these could be laws that limit liability on fraudulent transactions to a pre-specified amount. I previously raised this point in a speech on the Financial Services and Markets Bill delivered last year. Here, I'll elaborate why doing so will not only help redress the power imbalance between customers and banks, but also why it is fundamentally fair. Mr. Speaker, the government first shared with this House that it was working on the loss-sharing framework early in 2022. It explained closer to the end of that year that it was taking longer than expected and the release was further postponed in the middle of last year. The MES finally published a joint consultation paper in October, but it was extremely circumscribed to deal only with phishing scams. Perhaps more importantly, what the framework proposes is to adopt a waterfall approach, where financial institutions and telco operators will only bear the full losses when they, and I quote, fail to discharge their respective prescribed duties, end quote, and will not require payouts to be made to consumers if they are deemed to have done so. Alas, this approach will absolve financial institutions and communications companies from the costs of business, so long as they have done their part. While this does not close the door to other resolution mechanisms, such as FIDREC, it remains too cavalier in apportioning liability in the first instance. The SRF is a split based on effort, not outcomes. Put another way, should there be a realized loss, as long as the financial institution or telco operator can demonstrate that they have satisfied a certain set of obligations, which, to be honest, aren't even exhaustive, their loss share will not be half. It won't be a third or even a quarter. It could well be zero. Now, this cannot be fair. Think of it this way. Imagine that there are two cars driving side by side on the road. It is the responsibility of both drivers not to drive beyond the speed limit and to stay in their lanes. Should one car brake suddenly and it is ahead, the follower car should always maintain a safe distance. But what if the car was side by side and a child were to run out in front of one of them? If one of them were to swerve to avoid an accident and the other fails to yield, it is hard to say that only one of the cars should bear responsibility for the crash. Financial fraud, while preventable to a certain extent with sound system design and due diligence, is almost certainly likely to occur, regardless of the best efforts of either party. Much like the analogy that I just shared, there will seldom be a clear-cut pinning of blame on one party versus another. If so, it is only fair that both sides bear some of the costs of the loss. Such a legislative move may, of course, seem foolhardy. The standard line trotted out by critics is that protecting customers from the consequences of scams must mean that they are less likely to take the necessary precautions to safeguard against falling for them. This is what is often referred to as moral hazard. Since one side is protected, one takes less care. But while I am sympathetic to the argument in principle, a crude application of this theory is problematic. For starters, this counter-argument places too little faith in the agency of Singaporeans. After all, why would anyone wish to fall victim to a scam, even if they bore only limited consequences? Most of us would take active steps to counteract crime, even when we do not receive a clear payoff. Furthermore, just as we have co-payments in most insurance plans, so long as savers are required to absorb at least some reasonable amount of loss, say an upper limit of $100 or $500, then it's hard to claim that the consumer incentives aren't well aligned with combating fraud. We shouldn't think that only a catastrophic loss would be sufficient for individuals to practice the necessary amount of cyber hygiene. Nobody would rather lose $100 to a scammer rather than none if they can avoid it. Of course, this opens up the possibility that unscrupulous scammers may use this very notion of victim protection to defraud banks directly. Yet this is true for any form of insurance fraud, and there are well-established mechanisms for identifying and clamping down on such abuse, which would emerge when losses are more equally apportioned to both sides. This naturally brings me to the sort of indirect long-run benefits to having a system where both sides are made to bear some of the losses. Such a law would also likely lead to a sequence of favorable developments in the financial ecosystem that could render it more robust. Financial institutions would take more care to police phishing and fraud, since they can no longer pass on most of the costs of losses to consumers. They will also be a more pressing incentive to chase down transfers made to suspicious counterparties. And they will no longer condone unauthorized purchases made with ill-gotten money. Fraud detection and prevention tools have been around for a long time, but the widespread rollout of generative artificial intelligence has made the rapid deployment of the latest algorithms both less costly and simultaneously more sophisticated. Merchants and banks, in turn, would apply more caution as they seek to implement their own safeguards, lest they lose the right to accept payments or transfers electronically. Insurance schemes to cover fraud would likely emerge. And since all financial institutions would be involved by law, the market would deepen rapidly, keeping such insurance costs sufficiently low. Such developments could well be the unintended but welcome side effect of making our system recognize a truly equitable distribution of losses. Now, the government seems to be aware of the potential benefits of insurance mechanisms of this nature. In his initial discussion of CPF-related fraud, Minister Tan See Leng suggested an openness to such mechanisms. However, this was walked back the very next day when with the ministry stating that it had, and I quote, no intention, end quote, to consider insurance schemes. Now, while I appreciate that pricing could ultimately be prohibitive, one is left to wonder why the notion of insurance doesn't at the very least warrant deeper and further study. After all, even a limited liability insurance scheme, one that caps the maximum amount of fraud-related payout, would still be preferable to a system that is entirely bereft of such protection. So I've focused most of my speech on what can be done on the supply side. I will close with a discussion on why demand-side measures, while useful at the margin, are ultimately inadequate. Banks have already independently implemented certain features to introduce additional frictions into online transactions in collaboration with the Monetary Authority of Singapore and the Association of Banks Singapore. One is to implement a cooling-off period after a charge is made to the maximum daily transfer limit or other key account features. Another is to remove clickable links in emails or SMSs. But it is noteworthy that while these were first rolled out in January 2022, and if the continued proliferation of scams over the past 2 years are any guide, these measures alone remain insufficient to stem the tide of financial fraud. Other steps banks can consider introduce their own hurdles. For example, one could require certain classes of account holders, such as the elderly or less tech-savvy, to opt in to a scheme where they designate a separate individual, such as a trusted associate or a family member, as a second key, who will need to provide approval for transactions that are anomalous. But this will almost certainly bring problems of conflict and control of their own, such as when even well-meaning family members impose restrictions on others' use of their own funds. Similarly, cooling-off periods only work to the extent that victims are even aware or accept that they have been scammed. There are many instances of careful instructions by scammers building on the trust, naivete, or simply insecurity of the victims that lead them to consciously circumvent such circuit breakers. Lest we think that we surely will never fall victim to such schemes, recall that many fraudsters are extremely skilled confidence artists, and even professionals may succumb, as a study by the Police Psychological Services Division conducted in 2018 has shown. Mr. Speaker, the loss-sharing framework proposed by the government is a step forward in helping establish liability on financial fraud. But for the reasons I offered, I do not believe that it fulfills its fundamental promise of being fair. This has led to a steady erosion of trust in digital transactions, one that, if not addressed expeditiously, could result in a crisis of confidence over online payments and digital finance. To rebuild trust, regulators should require actual loss absorption by financial institutions and communications companies with an upper limit to consumer liability of $100 or $500 when losses are perhaps inevitably and unfortunately realized. This will not only be fair, but help evolve the system in the long run to a more robust one.